Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management.
Okay, good morning. June 18th research meeting. This one's all about pretty much what's been in the news most of the year, excluding, Iran. It's going to be SpaceX and some of the other, hyper, whatchamacallit stocks. We own these through a partnership with Overbay, so we'll just sort of talk a little bit about that, as well as the companies themselves. And then we'll get into charts of the week. Before we do that, just drawing your attention to the disclaimer as always on slide 2. So as I mentioned, we've talked about this before, including earlier today offline. We've got a number of LPs with Overbay Cap, and they are a secondary market specialist that invests in a lot of companies. Most relevant to today is SpaceX. So obviously SpaceX went public last week. Ticker symbol is looks like SPCX. It was priced at $1.35 and valued the company right around that $1.75 trillion mark. So the offering looked like it was looking to raise $75 billion, around half a billion shares or so. And the shares closed up. I remember on the first day of trading, they kind of popped up and then sold off and then actually finished higher on the day. And the real issue for us, so this is sort of the kind of thing we have to really, tighten up, is I believe in July, early July, mid-July, something like that, a larger portion of the restricted shares become unrestricted. And there are sort of timelines relating to, they're not really timelines as I understand it, relating to, certain of the investors and staff selling off their own shares. They're almost like revenue KPIs. So we'll just have to essentially with Overbay see what our options are. But that's the story with SpaceX. By far and away the second biggest one, maybe even the biggest kind of story, is this guy Claude, who has this company called Anthropic, and they closed a Series H round and filed kind of semi-confidentially, I guess you could say, a draft registration statement with the SEC regarding an IPO, and that's just after this financing. So sounds like they're lining up for a pretty big debut themselves. This company's growth has been kind of, we don't say off the charts a lot, but yeah, this is one of those, run rates in the 47 billion. I get excited when some of our companies have, run rates of 1 or 2 million, and this is 47 billion. So I guess everybody's using Claude. No one's thinking anymore. So I don't know how good that is, but investors are loving it. Databricks. So Databricks is in discussions to raise about 165 billion. So some of these evaluations are really huge. And this is Databricks, by the way, is a management platform. So with the raise, that's actually been increased from 134 billion earlier in the year. And the company reported, not surprisingly, annualized revenue of well into the billions, specifically 5.4 billion, and that was up way over 60% on a year-on-year basis. And it's these AI products that are really starting to contribute to the platform. CEO sounds like he's aiming for 27 as the IPO date, and that's just really because there's been so many other IPOs in a market that Mr. Godsey describes as crowded. And then finally, this is Ramp, and another really apropos, description. So this is an expense management platform, which is obviously a pretty hot commodity these days. They raised $750 million in the last round, and it basically tripled the valuation of the company like within a year. So, I don't know if that's good or bad. It's kind of hard to argue with the success, but again, the valuations are kind of creeping up there into levels where you kind of really need the company to like continually execute on their strategy. But with Ramp, the company is essentially positioning itself as the pipeline or mechanics of the underlying AI industry, and so they're moving well beyond things like corporate cards and their token spend management system as a strategy. That's almost like in the rearview mirror. If you remember, tokenization was sort of a hot topic 2-3 years ago, and we haven't heard anything about that for a while. But the fact of the matter is, with Ramp, they serve over 70,000 customers right now and processed $200 billion in volumes. That would be like transaction processing, not their own corporate revenues. But on that note, the revenues on an annualized basis, have surpassed $1 billion, and they are free cash flow positive. That should almost be common sense. I mean, if you can't be free cash flow positive on $1 billion in revenues, then yikes. But that's sort of the update there. So we'll be speaking with Overbay very soon in connection with kind of what to do here, because it seems like a lot of stuff is moving really quickly. And again, with some of these transactions, particularly SpaceX, I think it's important to get good guidance and good advice on when all of these shares become unlocked and all that sort of stuff. There was also, as I understand it, some exemption made to add SpaceX to the NASDAQ QQQ well before the standard, I think, 1 year waiting period. So lots going on. And from a charts of the week technical perspective, there's quite a bit going on in the stock market too. Of course, I don't specialize in that, but looks like we have a new Fed chair now that had his first meeting yesterday. And I think the real thing there was, I think the whole planet, was expecting no change, but it sounds like the elimination of any sort of forward guidance is sort of the signature that Mr. Warsh is going to put on his leadership of the Fed. Stocks reacted, I think, negatively to the development. The development being the absence of kind of more clear guidance as to whether they're going to cut in the future. I think that was sort of the presumption late last year when Trump was nominating him and that sort of thing. But for the time being, S&P 500 is kind of nestled in that 7350 to 7550 level. Andrew reckons that it's going to take a pretty obvious breakthrough one of those zones to create either problems or opportunities, depending on how you look at it. And so here we are with the S&P 500 kind of moving from, let's say, slightly overbought a week or two ago, back down to that dotted line at neutral, then back up again, then back down again. So it's kind of clinging to that slightly overbought zone, which I think is okay. The real issue is sort of this. So he has kind of a near-term, quote, tactical pivot point, which is more or less right where we're at now. And then that bigger picture zone. So down below, there's sort of a more established support zone. And if you kind of get down through there and crack through that and fall through the ice, it could be not so much fun. From an advanced decline perspective, this past week we did see sort of a reduction in that ranking there, but as you can see, it's been creeping up kind of nicely since certainly the March lows. Of course, much of that through April was just really retracing the reduction in this indicator over March. But since that time, specifically, from mid-April onwards, you can see that it's been trending a little bit higher, so that's good. Taking a look at the SOX, we talked about this before. I think 2 meetings ago, the chart was pretty much straight up, and it looks like it hit a brick wall overhead and had a bit of a correction there, or taking a breather, I guess is the way you could say it, because that lower panel again, the RSI, or what's called relative strength in technical terms, you can see the arrow down there pointing lower. So we'll have to see how that pans out. So Mag 7, Andrew calls this one of the more ominous charts that he's looked at this week. It did double top right there. You can kind of, if you squint, make out the two little black arrows pointing to the peaks there. They look like two little ears on a cougar or something like that, or a lynx. And the mags really is now kind of, he says, struggling again. And there is this sort of support vacuum. That's the spot between that lower, resistance line, or what was formerly a lower resistance line, and the two support lines below it. It's just not really obvious where it goes, I think, is the bottom line. And without sort of, any, like a lot of the earnings is done. And then so that's kind of in the rearview mirror. The Fed has said its piece. And so now you kind of say, well, what's left? And what's left is usually these technical indicators, and you don't even have a lot of those. So certainly caveat emptor with the Mag 7. And then just looking at, this is the software index. So this is the IGV. It really got hit hard when AI, started becoming front page news. Like, I'm talking front page news, even in, publications that have no kind of investment background. But it has hit this support zone. And so the question is, does the confluence of the unit price, so this is an ETF, does the sort of confluence of the unit price, the 200-day moving average, and this fairly wide support zone where we're at basically now function to help software ricochet back higher in terms of the next couple of weeks of trading action? We shall see. And then yield curve. So if Chris Curry's on the call, that's always a positive in my opinion. But taking a look at the yield curve, usually with yield curve inversion, it's kind of viewed as your most obvious recession indicator. That hasn't happened, and there's a very famous, I believe it's Carnegie Mellon University prof called Campbell Harvey, who's actually a Canadian. Professor Harvey was the guy that I think wrote the original paper on how yield curve inversions can be tied to recessions, but it just hasn't happened. If you believe the stats coming out. I mean, I think the first quarter US GDP was like 1.9%. Someone can verify that, but that's not even close to receding. And so, it's kind of hard to I guess know where you stand when you have an inverted yield curve. I mean, it's sort of uninverting now, but it does put into favor more of the defensive areas like the dividend paying stocks and so on. So that's pretty interesting. And then I also think this relates to the banks in some way. I haven't had a chance to go over the banks much. And then oil. So just talking about the price fluctuations of oil. They've been whipping around a fair bit. Obviously, it came off that yellow candlestick on the far right. I believe corresponds to the quote deal being announced. But the issue is that oil kind of remains above where it was trading before the war. And you have to remember that just because a bunch of politicians have a meeting and sign something, the reality is there's still millions and millions of barrels of oil kind of floating around aimlessly, in the world's oceans. And so it takes a while to get that from that point. It's a long road and a long journey from there to filling up your Volkswagen with gas. So just keep that in mind. There are millions of barrels still in terms of a shortfall of new supplies, and you have seen some depletion of existing supplies since the military conflict began. So, it is kind of interesting that oil has fallen off this much this rapidly. Again, it's higher than before the war, but the other thing you're having to consider is that the Chinese economy looks like it is receding a bit. A few more quick ones here. This is gold. Gold and silver were the stars of I guess 2025, certainly into this year too. And then they spent some time selling off. It does look like this red line represents a key pivot point, and so if the price can recapture a price point above this key pivot point, it would be just simply more evidence to suggest that the lows for the cycle have been made. We love gold and the metals. That's sort of obvious. And then one blank slide just to see if anyone's listening. Thanks very much. Back to you, Dave.
We're listening.
Oh, that was a great last slide.
Yeah. That last slide would be worth a lot in an art exhibit. Okay, Ken, take it.
Awesome. Okay, I'll just start off just with the two disclaimers for Canadians, and then Americans just pause. Just looking through here, S&P 500 made a 6-box reversal off this support it created. Really strong rebound after the pullback that we saw last week. Obviously, there's peace deal, SpaceX hype, kind of a blend of, I think, two things. And it seems like we're back onto risk on, where the market's being led by AI, the Mag 7, and high growth, where there's some energy weakness, obviously, with the Strait of Hormuz reportedly going to be open sometime. I don't think it's fully opened yet. Momentum positive on the monthly still, which is a positive indicator. Overbought, oversold 40%. That's a small increase. And it's been at moderate level over the last 3 weeks, which is actually a positive sign when you compare it to the previous 5 weeks when it was extremely elevated. And I had mentioned the RSIs were at very unsustainable levels. And then just looking here, return to a buy signal would be a 2-box increase through this all-time high resistance. So basically back to all-time highs. NASDAQ, kind of a similar story. Overall, a 7-box increase, but a bit of a pullback on the chart. You can see it actually bounced off the support it created back in May last week. So that's a really positive sign. The NASDAQ's going to reportedly, because index rule changes, which Joe mentioned, I think in late June or early July, SpaceX will be included in the NASDAQ 100, which, according to something I read, about 7 to 9 billion in forced buying immediately. And then I think some other index funds have about 6 months to kind of increase the exposure there. It seems like all the strength this week is from AI and tech. You can see those 3 names right there. 3 of the names of the year, you'd say, acting like meme stocks. These are 100, or maybe not all of them, but I mean, Micron's a $1 trillion company. These are multi-billion dollar companies that are moving like penny stocks. And I kind of think it's a reflection of where we are in the cycle. Price objective increased back to bullish after decreasing the last few weeks. Up 19% year to date now, and then the overbought oversold 57%. That's the highest in 3 weeks, but well below the previous 4 weeks. Kind of similar story with the RSI to the S&P, but at an even more elevated level. The Dow Jones 1-box increase over the week, 2 column changes, new buy signal this week, which is the 6th straight. That's the first occurrence dating back over 10 years. So really bullish move for the Dow, but also a strong setup with these support lines here. It did reverse its negative monthly momentum streak this week, which is positive. The overbought oversold was the highest since July 3rd of 2025. So these value indices really overbought this week, but not at the levels that the growth ones have been at for the previous few weeks. Looking here, the TSX, $3 increase to an all-time high. Strong rebound for most of the constituents this week, other than energy, obviously. It also flipped to positive momentum. The overbought oversold was the highest since January. The rebound by miners, driven by less inflation worry, which would obviously more inflation worry could be higher rates. And there's a rotation from investors out of gold and into potentially interest-bearing securities. So drove a bit of a rebound in gold, and then obviously yesterday we got that sell-off after the Fed meeting. So we'll have to see which trend sustains. And I think this morning the price of gold is still down about 2.5%, but I think futures are moved in the positive direction, especially the risk-on indices. Looking here at the VIX, there's about a 3.5% decrease over the week. I actually forgot to paste a new image. That's my apologies. But peace deal could obviously move the VIX back to the 15% range. Still remains elevated relative to that. And the target is about a 9% area, which obviously be a multi-year low. But it's a huge decrease from last week when it was at 38. Bullish percentage charts, these two both moved higher. I'll flip quickly through this, but you can see we're at all-time highs. The NYSE, I think this is a great representation of breadth. Only about 54% of the companies are trading in a bullish pattern, despite the market being at basically all-time highs. S&P 500 only about 60%. So kind of lacking that breadth that you see often at all-time highs, really kind of a reflection of the market being pulled along by just a few companies and predominantly in recent months, one sector. Percent positive trend here, not really a lot of movement, so I'll just flip back to the Toronto Stock Exchange technical indicators, which both haven't moved recently. So we'll have to see in the coming weeks with the price of energy pulling back and potentially the price of some of these precious metals moving higher if that changes. Speaking of commodities, energy has dropped from first position a couple months ago to the start of the conflict all the way to third. Agriculture actually picked up a number of relative strength buy signals. I think that was just a bit of a rotation. And then precious metals actually picked up a number of buy signals here. It was sitting at 28 last week, so up 5. And then within the sectors, technology continues its run, but industrials, a number of our industrial holdings are at 52-week highs or just off of them. Picked up a number of buy signals, jumped over energy, which obviously had some weakness this week. And then there was also some major movement within the size and style area, where we continue to see the deterioration of some of these large cap value names that we really like right now, but it's just the kind of market we're in, with the most strength obviously in large cap growth names. But then large cap blend, obviously the biggest names continuing to lead the market, like I've mentioned, but also that growth area also dominating value right now, or at least in recent months. Looking here, this is just after the press conference yesterday, Kevin Warsh. Rates obviously were unchanged. The Fed forecasts has now flipped to a hike in 26. Warsh also highlighted wanting reform at the Fed and kind of not discounting the job market at the I guess the in favor of price stability, kind of critiquing past Fed leadership. So I'll have to see how he changes that and what he focuses on. But you can see here, there's right now basically not a 50-50, but right now with the rate, the Fed funds rate sitting in this range right here, it's a 40% basically chance that we get a hike or not, and then actually almost a 15% chance or probability of two 25 basis point interest rate hikes. And I think Fed futures as of close yesterday were pointing to a potential hike in October. So we'll have to see how that changes. This is just the S&P's equity performance following an initial rate hike from the Fed. So this is every time going back to 83 that the Fed has hiked. You can see how much they hiked by. You can see the 1 week performance, the 1 month, the 3 month, which is generally negative. But then you can look the 1 year out. There's actually only been 2 negative occurrences where 1 year after the Fed began hiking, where there was negative returns in the market a year later. That was in 1987 and obviously in 2022. Looking here, this is just a chart from the Financial Times when I was reading it yesterday. This is just bullish bets on the dollar, and just with obviously the hike or the inflation worry was rising, a changing Fed leadership, and we've seen the highest bullish bets on the dollar in well over a year and a half, and a complete buck to the recent trend where we've seen a lot more bearish bets over the last year against the Fed, or not the Fed, the US dollar. Looking here, this is crude. Crude's obviously pulled back pretty severely in price. I think this morning it's trading around $75, kind of has broken numerous support lines. Obviously, there's news of a peace deal. The final framework is not out yet. Trump says that it'll come out sometime in the next little bit. I think he said at the end of this week, so we'll see if it comes out this weekend. It'll be interesting to see how long official long-term framework can wait until the price of oil moves higher. But as long as I think the Strait of Hormuz opens up, obviously we're going to see lower oil prices. I still think they're going to be elevated, especially relative to where they were to end last year in the high 50s, low 60s. So continue to like some of the energy positions that we're in. A lot of talk. This is just one chart. I think I've shown a couple of these over the past few weeks. This is just U.S. inventories of oil, which is hitting pretty low levels, multi-year levels. This is in Oklahoma. So it's just one example. There was really a lot of worry reportedly in the Trump administration, but also the energy industry, that kind of the suppression of the price that the world has been doing to the price of oil in recent weeks through oil reserves being released was only going to be really sustainable through into August, and after that probably not able to keep up, which would obviously increase the spot price pretty substantially. So I think obviously a major driver of why Trump is potentially finding this agreement, especially at this time as they head to the polls in November. And I think the Republican Party is pretty in the passenger seat when it comes to both the House and even the Senate, I think, is up for grabs. This is just a quick table from Dorsey Wright, something we look at, market relative strength. So a company's relative strength relative to the market. These are the stocks with the longest running market relative strength buy signals. You can see some of these companies go all the way back to 2000. You can see their annual return, the stock's return, the market's return since their relative strength signal date, and then the outperformance. Obviously, some more recent ones in the 2012s, 2013s, but you can see going all the way back the likes of Amtech and Lind, which we actually have some exposure to both, and just the consistent outperformance of these companies relative to the market over time. Now, obviously, there's two which kind of skew the results negative, Honeywell and intercontinental exchange, but for the most part, a really interesting indicator, I think. So just wanted to highlight Lin, which is a chemical company, obviously industrial gases. You can see chart here, strong support lines. We actually own this in the conservative income fund. It's up about 20% year to date, scores 4 to 5. Slightly elevated valuation versus the industry, but it has industry leading margins, steady demand, and it's able to obviously it has some pricing power with its customers, and a strong cash generating business. So we continue to like this company, but it's really interesting to see these long-term buy signals in terms of relative strength that some companies hold. Lind, for example, since '01. So really interesting chart there. And then this is just a chart that I saw in a newsletter this week, but it's just looking at the mining investment from the United States and China in Latin America, only Latin America. You can see since 2000, China's more than doubled the US's investment in Latin America. Obviously, China has invested in more than just mining, and you have these investments, hospitals, infrastructure in Latin American and even African countries by China, which is how China has been able to really, I think, create some unique relationships with countries around the world, whereas the US has spent on other things, including conflicts. But I think these two charts are a reflection of what's going to continue, a showdown for supply chains, assuring allies sourced critical minerals, but also industrial metals. And I think that's going to be a focus, which we've seen from the Trump administration, but I think even more moving forward. This is just the market cap weightings of a few groups. You can see defensive at a low we've never seen before. This chart goes all the way back to 1972. Only, I think, mid-teens, 15% of the market is defensive right now. You can see traditional cyclicals is actually at a low, going back all the way to the same period. The brief period, obviously, at the dot-com bubble where it was around this area. But you can see tech. That's the bubble that they were talking about in this article. It's tech and tech related, which is closing in on 60% of the market cap weighting. Is that sustainable? We'll have to see. But I think for this week, that's it for me.
Great, Ken. Do you want to go over the weekly beacon? Do you have that open on your desktop?
Yeah, I can actually. I just had
Let's
it
do
open.
a quick overview of that. It's ready to go tomorrow morning.
Yeah. Okay. Yeah. So just a quick go through this quickly. Just talked about the peace deal, what it means for energy market, inflation, what it means for energy prices, what's happened with the United States Strategic Petroleum Reserve, where it's sitting at right now. You can see here it's at its lowest level since it was really ramped up in terms of the supply within it, all the way back to 1983. Just talking, and then I also talked about market hype and what's driving recent returns in the markets. Obviously SpaceX and its IPO, its pop, the original lockup that a lot of shareholders have. But I also talked about the retail investors flocking it even after the IPO, which has led to this significant price appreciation. And I explained that with actually just the South Korean market, which has become a very heavily retail focus, or a speculative retail bubble within South Korea. Obviously, a lot of those names have grown substantially over the past few years, especially the ones driven by or tied to AI. But you can see about 800 billion in net purchases were created on the first day SpaceX IPO'd in the secondaries market. When you compare that to Micron, the company that's been on fire this year, about 750 million over a 3-month period. So 90 days, or not 90 days, but 20 days of trading month. So about 60 days versus 1 day. and SpaceX is still about 50 million higher. So you can see that level of speculation. Just talked about equity issuance, the tops that we're at, the semiconductors rolling return and where we are compared to previous cycles. The inflows, not just in names like SpaceX, but the overall semiconductor industry. This ETF that tracks the semiconductor index by iShares has doubled in assets in 3 months. So obviously something that is potentially not sustainable. I talked about gold and central banks rebuying it and the commitments they're making right now. Quick thing on electric vehicles and that industry, comparing a bunch of the names that have really just destroyed investor capital, including the likes of Rivian, BYD, Lucid, Li Auto, Polestar, and how obviously Tesla is the exception. But basically, it's all tied to this outlook for electric vehicle sales in the US, which have once again, for the third straight year, been forecasted lower. And they were actually forecasted lower in China as well. So kind of a big piece on the electric vehicle industry, which we've touched on a lot in the past. And then quick thing that Gilbert wrote, just what we're looking at in the next week, talking about the Fed, Kevin Warsh, SpaceX, and a potential peace deal and how that impacts markets in the coming weeks. So a lot going on. So give it a read tomorrow morning.
That's great, Ken. Okay, I'll move on here and cover a few things and then pass it over to others to talk. Okay, I'll start with the video. Just came in now.
Hi, welcome to this morning's brief. My name is Joe Tozzolo. Today is June 18th. Looking at yesterday's action, equities down for the most part. S&P 500 was down 1.2%. Equal, it was actually fared worse, down 1.5%. Across the board, equities had a pretty rough day, in part because of Warsh's first FOMC meeting, and as we'll get into in a second, rate projections came in a bit higher than anticipated. We did see crude oil up almost 1% yesterday, although that was down. That's down about 1.5% after hours, after more positive news on the Iran war front. So getting back to that Fed meeting, they came out with their projections. Actually came in quite a bit higher than expected. Immediately following the announcement, traders started to price in roughly 40 basis points of hikes. So 1.5 rate hikes through the rest of the year. Whether we get that or not, we'll see. Obviously, some of the information that went into these projections, like crude oil, had been cooling off and looked pretty good, but with the continued move lower, that we could see that easily come back down as those inflationary pressures dissipate. Looking at the 10-year yield, still in this range, has pulled back a little bit. No action following that announcement, really. No reversal back up into X's or anything. So, we'll see how it shakes out. A lot of times these initial reactions from these FOMC meetings get retraced pretty quickly. We did see equities kind of sell off right into the close yesterday, only to rally right after hours. So, while we did see the S&P down a little over 1% yesterday, it did rally quite a bit in after hours trading. Now, with interest rates, there's a lot of worry about the economy running hot and things like that, where really the one big place where we're seeing the higher interest rates really have an impact is housing. So this is looking at the inventory surplus or deficit. So it's just looking at the current inventory versus the long-term average here on a state-by-state basis. The South has really been a hotbed for housing weakness. You see some pretty big numbers there. Texas, Colorado, Washington, Tennessee. However, you do see places like the Northeast and the Midwest, like Illinois, Wisconsin, Ohio, even holding up pretty well. Not as much supply coming to market as the long-term average, but we do see it having an impact in the South, particularly with those higher interest rates. Looking at a chart of the S&P 500, no change yesterday. Just wanted to highlight some support and resistance levels. 7,600 as resistance, 7,250 as support here. We kind of appear to be chopping out another range, kind of consolidating after this big push higher in April and May, which isn't too surprising. We typically say you can either normalize via a pullback or in time. And right now we did pull back a little bit, but it seems like we're more normalizing throughout time here, up around 7,500. Looking at crude oil developments, pretty good looking chart action if you want lower oil prices, as I imagine most people do. Yeah, we were up about 1% yesterday, however, and after hours trading, after more positive news, we do see crude trading right around the 74 handle. But a pretty good looking chart. I mean, you got a series of kind of lower major highs and then a break of this support here in the 78.80 range. So we'll see how that develops further. One area that obviously isn't good for our energy stocks. So we're looking at XLE here, fund score 2.5. It is up 22% this year. A lot of that action came in February and March, and it really hasn't gone anywhere since. We saw it break a triple bottom here at $55, support at 54, but below 54. And I think if crude oil prices remain start to remain subdued, you'll probably see this continue to retrace down to its positive trend line around 48, 49 on that trend chart. With that said, we'll go ahead and wrap up, and thanks for listening.
Yeah, that was quick. Okay. Learned a few things there. That guy's happy that oil's going down. He must not own any oil stocks, but I guess it is better for the economy and just the hidden tax that the higher price brought in. Let me show Mike Coolbaugh next. Okay, these are from Tuesday. Wave of equity supply. So turns positive for the first time in a long time, since 2020. Inflationary impulse, not just oil. Recent inflation readings have given the rate cut crowd a bit of pause. Excuse me, even if we get a pullback in oil, can the Fed look through this dynamic? The math for bulls. Per Piper, the bottom-up 2027 S&P 500 earnings per share estimate is $393. Here's where the market would end this year, assuming this estimates hold and multiples rise 1 point, stay flat, or decline a point. Yeah, so 8,500 on the high and 7,750 on the low. Yeah. So 8,000 is the next stop, it looks like, and maybe be the final stop for a while. The great disconnect. A lot of weight for the bulls is being placed on margin improvements due to AI. While forecasts for revenue growth have been trending lower, operating margins have exploded. Yeah. Now we're into Van Eck Semiconductors. If today's reversal bar holds, it's extremely dangerous given the growing negative momentum divergence. Micron Technology. The only thing that's been crazier than semiconductors lately has been memory stocks. The same precarious momentum divergence. Yeah, look at that. It's up tremendously, like almost 3 times. Korea, we own Korea. Speaking of memory, Samsung and SK Hynix have powered the South Korean ETF, massive 115% rally through June, but again, the same cautionary setup. And the CBOE 1 month implied correlation index. Here's why the plunge in implied correlations is so concerning. It breeds complacency because things are so quiet at the index level, and complacency tends to precede short-term spasms. Yeah, this guy's good. Find some excellent data points. Okay, that's it for that. And this morning coffee literally just came in now, so I haven't had a chance to review it. I saw the one headline here that supposedly Apple has agreed to go into business with Intel and do their chip production locally in the States. So that's good for owners of Intel and the U.S. government that owns, what, 20%, I think, of Intel. And but here we go, more price increases, so more inflation. Inflation is everywhere, and they're just fueling it by doing decisions like this. But they should never have allowed the offshoring that happened. With an eye of there being problems with that, and sure enough, there are. Okay, let's move on to here we are. So this is as of yesterday. We've got the Canadian market double digits, venture exchange negative, and India is the only other negative one. Looks like everything else has come back. Germany's back in the green. China, France. Lower returns in the US with the NASDAQ leading at 12%. So, yeah, just generally a happier, more green environment for those indices. We've talked quite a bit about oil. You can see it's had a terrible month here and week with the settlement of the Iran war, supposedly. We'll see. See if something is truly signed on Friday or if it's in more kicking the can down the road. Yeah, it's a media hot potato. It's just they do not want to see Trump succeed in any way possible, and I'm not supporting him at all. But it's become so one-sided. It's concerning. But anyways, let's not get into politics. Nat gas is really doing nothing here. I'll talk about precious metals when I go to the point and figure charts, and same thing with Canada, US dollar, where nothing's really happened. And there's Bitcoin. Look at that, down 27% year to date. Yikes. That's got to be the worst performing asset class. Yes, it is, at least on this page. Okay, finishing up here with the point and figure charts. And excuse me. Here's a picture of SpaceX that I did on a $1 chart. So literally came out at 135, started trading, I think around 145. I don't think anybody, or 159 according to this, up from 135 on the opening day, and then just straight up, and it finally did peak out at, it looks like, let's get this right here. Top price was 225, and now the point and figure is quite amazing how these tremendous rises are almost always followed by recovering half of that gain all the way down, and sure enough, that's what it's done, and it will put in a column of X's here tomorrow, where it's risen from the bottom of 188. So we're watching this carefully. We do have an exposure. We've made 8 times our money on it, but we have to find a way to see if we have an exit. And if we don't have an exit, then we're going to do our own little bit of hedging just to try to maintain that return there. I personally think a lot of people are going to round trip on this one, but we'll see. 71 cents for the Canadian dollar relative to the US, no change. Year to date down about 2.6%, and the short and the long-term indicators both measure slightly down and way down. So nothing to do there.
sometimes that's the best thing in investing, is doing nothing. And so we won't be hedging our U.S. positions. Now, that said, there's U.S. dollar spot index. It's up a little bit over 100 now, but it still measures down to 95. So that the largest currency in the world continues to just it's trying to drift down, is what its intention is. Now, crude oil, look at that. It's up 33% year to date. Still measures up from 76 to 82. Nat gas measures down, as do the producers. Copper down, uranium back up. So this flip-flops just about every week. We see uranium trending down, and now it appears to be trending up 10% year to date. So we'll continue to hold our uranium positions. Here's gold. It's done nothing this year, pretty much flat. And after having an incredible last year, second best performing asset class next to silver. So the futures are showing no movement, and same thing for the spot price. So it's taking a rest, and it will for a bit until maybe the direction of the U.S. dollar gets determined too. And if it's doing nothing, then gold's probably going to do nothing. The gold buck index does measure up, though, tremendously, as does the VanEck majors. The VanEck juniors do not, though. So it looks like it's a push more to quality, and the margins in the major space is tremendous. What they're able to do. Problem with inflation, though, is the next thing we're hearing more about is labor costs are on the rise. Silver really doing nothing. The miners are overpriced, as are the juniors, and platinum's doing nothing. Bitcoin hasn't changed there, still has a 22,000 target on it, and the rest of the crypto space, looks. Although the index itself is not interesting. That one is flipped over here. It's 3,000 up to 3,600. So something could be changing for the overall sector, but doesn't really bother us. We have little to no exposure there. Finishing up with interest rates, we've got the 2-year at over 4% on its way to up to 5.75. The 5-year measures up, the 10-year and the 30-year. So no change in the yield curve, but with the 30-year over a 6% handle, that would be a real problem. That would be real inflation that would be stuck in the system that they can't get out. They certainly can't raise rates, or excuse me, lower rates. I take that back. What's going to happen is higher rates in the short end. So they're going to be forced to raise rates to keep up with just the curve itself. And I think that's it for me. So Shane, you ready to go? Shane?
Yeah, Shane, Sean. It's all right.
Sorry about that.
No
My
worries.
brain was in neutral. Take it away.
All right. Okay, here's the macro overview, not investment advice. With my returns this year, you wouldn't want it anyway. Positioning, starting to redeploy capital. The Iran war looks like it's winding down, but I'll have a couple more comments on that later. On long biased exposure, still liking AI, silver, copper, defense, an overall debasement trade, and eventually I will add to crypto, but not right now. I have been hedged over the past few weeks, and it's been a mixed bag. Think about this, guys. When SpaceX is included in, say, the NASDAQ 100, on a valuation basis, it's because of its 100 times sales, basically, we will see a new level set of I guess overvaluation. The price earnings multiple of the NASDAQ 100 will definitely be at a peak. It's trading spots with Microsoft as the 5th largest company in the world. Okay, so I still recommend some hedges. I think SpaceX eventually is going to be sold off hard after this squeeze. We'll get to that later. I'm looking at some shorts on oil and some energy stocks that have run up materially. The crypto market is still a disaster, as Dave has pointed out. Just stay away from it. The Clarity Act is supposedly on deck for July 4th, but we'll see. Asset classes, you know, Bitcoin Ether did pretty well over the last week, but still a disaster year to date for the past year, whatever you want. And, you know, the big news, yeah, oil down a lot. Economics, Warsh is now fully in charge in the Fed. We're going to have less guidance. He is trying to figure out a way to make inflation look more muted. And I'm pretty surprised he didn't say the word transitory, but it's probably coming. We're still in a low fire regime with, you know, significant CPI. PPI was a big surprise, coming in at 6.5. You know, all eyes are on employment in my mind. If employment deteriorates, we're definitely going to be in a stagflationary environment, and that will take that'll take a few turns off of the multiples applied to the equity market. Growth looks reasonably good. Recession even less likely on the falling oil prices. Commodities have been turbulent. You know, higher rates hurt metals. We're not seeing the money printing debasement that many had expected. And like right now with global trade, you know, being somewhat muted, the central banks will still keep buying gold, but not as much. The US dollar, you know, had a bit of strength over the last 2 days on the expectation and the forecast of a higher Fed funds rate, a higher short end rates. We saw the yield curve flatten quite a bit. The yen is getting to a breaking point. This is going to be quite interesting. I mean, there's still decent carry between 1% in the shortest end, where the Bank of Japan raised rates in the past week by 25 basis points to 1%. You know, you compare that to like 3.5% in the US 3.75. There's still carry to be had there. You know, quite a bit of carry, frankly. But there are a lot of other leveraged assets, particularly equities, which if we do get any type of a turn, will be challenged. Gold's in a bear market. It's down. You know, I've had that blue trend line up for 3 or 4 weeks now. It hasn't broken it. It bounced off its 200-day moving average. We're seeing a lot of red in the heat map. We're just, you know, just not seeing any indication that we're going to see forward momentum there. We got to see basically a bias to even easier money in the United States. Silver's just going sideways. I like it long term. I think there's going to be a renaissance in solar around the world. China's going to be importing. They're already importing 100 ounces a year to produce solar panels, 100 million ounces. We could see that double, and you could see silver maybe not take off parabolically like it did before, but I do think that it can do 20-30% from here. Oil. So I read through the 14-point memorandum of understanding to negotiate a final thing over 60 days. I'm just going to say good luck. Israel doesn't, you know, like if you watch interviews on the street in Israel, they think Iran won. People are outright questioning Netanyahu for going to war in the way he did and talking about his failure. Yeah, and they're not, they've said outright, like, we are not withdrawing from Lebanon, which is a key term in the MOU. Trump seems to be distancing himself. So from, you know, supporting Israel further on this, he knows he's got midterms coming up. If he can get oil back into the 50s and 60s, he can really do a victory lap, at least domestically. He's, you know, so right now, oil is still pointing lower. The heat map called it, you know, January 9th, it signaled that things were headed higher, and on about May 22nd, it indicated that things were heading lower. The heat map, again, I'll remind you, is a combination of 8 indicators that range from 3 days to 60 days. They're different forms of indicators, but together they work together to say what is the forward likelihood of a positive Sharpe ratio, right? So it's not just, is the market going up, is the market going down? It's like, are you getting paid for the risk? Rates, man, rates are just pretty boring. The only thing that really moved is the 2s10s curve flattened from about 42 basis points to 29 basis points. Everything else is steady as she goes. Even high yield spreads, you know, like they are tight. That used to be, that's what I traded for many years. Like seeing in 271 on high yield option adjusted spreads is pretty impressive. One thing that was noted is the biggest borrowers right now are also some of the most credit worthy. So like the Google and so forth, very Microsoft, very strong balance sheets behind big borrowings right now. Here we can see the US 10-year in red and the 2-year in blue over the past 5 years. I've put this on a log scale so you can see, you know, we at the very beginning in 2021, we went from like a fairly steep yield curve up to an inversion where the blue was above the red, and now we're, you know, in a very flat yield curve. You know, typically people are saying, oh, after a big inversion, we're going to have a recession. You know, I would say maybe 2022 was like a shadow recession. Are we going to have it again? I think that this administration is poised to juice the market. Despite that, the U.S. equity market is still in fear, while the trend indicators and the heat map are pointing to a bullish overall market. The breadth is still pretty good. The VIX term structure is normal. You know, spot VIX is at 17. If it gets down to 12 on a crazy bull run, then I will be buying futures or a call option on the VIX. The equity regime model that I've been working on says we continue to be in a bull market. This is day 46 of the turn into this bull regime. And here you can see a table of how likely, what is the probability that we will remain in these states over 1, 5, 20, and 60 days. You know, and doing a little math, and this is all, you know, hand waving, you know, guessing with numbers, I guess. You know, the bull is expected to remain at least another 19 days. So that's a month. And over a month, you know, the 60-day forward returns, the mean is 3%. You know, so what could we earn over the next month on the index? And this is off of triple Qs. Maybe 2.25%. I think that's pretty good given where things are. Here's a chart again showing how this mathematical model broke the triple Qs, 20 years of triple Q data into bear sideways in yellow and green bullish markets. The S&P looks to be heading up. We look at the heat map. We've only got 2 red dashes in the shorter time frames. Our RSI looks pretty good. You know, we're about to flip to the positive in the DMI, which is a nice smoothed look at a trend. You know, SpaceX is, I think, in about 10 days, 10 trading days is about to be coming in with a 4% float and a lot of money being forced to buy. I think, as Ken noted, I could see a bit of a squeeze happen, and then after that, I don't know. It just doesn't look good. If you're Ontario Teachers Pension Plan and you've now gone from like 300 million to 14 billion, are you going to put up with this governance structure? Like literally, can you stomach participating in a corporate monarchy.
And
So I'm
even
still
if they
saying,
are locked in, there's an options market available for it now too. So
yes.
it'll be interesting to watch that and see how active it is.
Yeah, I looked at that. Like it's very active. The implied volatility was 126% the other day. So I looked at buying a put, and I mean, it almost didn't seem worth it. We'd be back to the IPO price at my break even. It was really something. Like that is a crazy market. So I'm still telling people, like, consider hedging something now. I'm now we're past the worst of Iran, in my opinion. I do think that Israel is going to mess it up, but we'll see. But if that is past us, then, you know, we have the potential to go into this low rate, high liquidity, super cycle of asset appreciation. You know, that could mean that for the next 3, 4, 5 years, we see the market go up 16 to 30% on average over that a year for that period. You know, right now employment is robust, rates are reasonable, and Trump, Warsh, and Bessent have a bias to lower rates. That they have to have inflation come down, and for inflation to come down, they knew they had to end the Iran war. Midterm elections are coming up. You know, government spends like crazy. Investment sentiment is still pretty good. Like if SpaceX failed, we'd be hearing a whole different narrative right now. But right now, the demand in AI and data centers demand continues. So right now, the punch bowl is there. It's spiked, and cups are full and getting drained quickly. Crypto's the exact opposite. Just stay away. You know, like I've been saying it. You know, I haven't changed this slide much. It's a broken risk asset. Nobody needs it. The Clarity Act is not yet passed. The downside in my mind is 45K into the fall, September, October. That's a significant fall. But like as Dave pointed out, 22,000 is in the cards by some market perception. Here's the bear market. You know, you can see right now we've got the heat map is red top to bottom. Just stay away. Like it's not there until the money printing and the basement are front and center. This is not going to win. I took a look through my list of altcoins that I monitor, and what a disaster. I mean, stuff's down 50 to 85% in that space. 50 to 85%. If you're going to buy anything, I like Aave and maybe a touch of Solana, but you know, that's playing with a falling knife that's actually on fire. Here's my parting thoughts. The Iran war, Israel did not get what it wanted, and it started this war. It was not a party to the negotiation. When you read that 14-point memorandum of understanding, Iran is getting everything that it wants. The generals of the Republican Guard are dancing like they're a self-funded army. They got their fingers in industry. They're going to have sanctions lifted. They're going to be getting what looks to be like a $300 billion guarantee from the United States for a redevelopment fund. And if you go onto YouTube, you can see videos of street life in Tehran, and it looks like any European city, right? The one thing you can say about the US, other than bombing that children's school, is they kept to military targets, and life continues surprisingly normally in the major cities. SpaceX, I mean, this is the craziest thing I've ever seen. It's an insane valuation. The governance is, monarchish. It's a tiny float, and they aggressively lobbied for an index weighting. They're the 4th or 5th largest company in the world, probably 5th or 6th maybe right now. But I do expect a bit of a squeeze as guys shoehorn in at the last minute. And I've been seeing on CNBC and Bloomberg, people now talking about SpaceX buying in Tesla, which we talked about here 2 or 3 weeks ago. Might be worth like a small option position, like a call spread or something. And then SpaceX paid $60 billion for Cursor. Cursor is a glorified word processor for people that write computer code. Okay, is it the best? No. Is it worth 60 billion? No. Like maybe 60 million. Like I just don't get it. Like I use Cursor, but I've moved on to Visual Studio Code with add-ins, and I like it a lot more. Like this is like, I don't know. That was he's got more money than he knows what to do with. That's for sure. AI. Joe mentioned Claude earlier. I use Claude every single day. I mean, it is beyond my wildest dreams what I can do with that AI model. Between coding, things that I used to have to pay programmers to do, to answering questions, to dropping it into Excel and using their financial modeling tools. It is unbelievable. It is the corporate AI of choice. Okay, so I have a friend, you know, my age, you know, that would be damn old with gray hair to everybody. And he's looking for a risk management job, senior risk management job. And I told him to learn Claude. He put it on his application, and the recruiter that picked him out said, you went to the top of the pile because you have familiarity with Claude Cowork, right? It is going to become the new CFA or the new MBA, in my opinion. But now the government comes out and tells Anthropic, you have to take down your best product for anybody that's not a US citizen, even if they work for your company. And so OpenAI literally had no choice. They just took it off the market. What are you going to do as a company if the government says, oh, you just spent whatever, like $80 billion building a new product, and we're going to tell you no, we're going to tell you who you can sell it to? What's next? They're going to say the price of who, you know, people pay. Like, this is pretty intrusive. And, you know, Anthropic is a pretty left-wing company. They've had their run-ins with the Department of Defense, but this is a level of government intervention that I find concerning. Like, Canada's already been behind in access to many models because of our information laws in Canada. Like, Google would not let, still does not let me use their absolute state-of-the-art model. That's crazy. So what's that going to do to the potential valuation if the government is going to cap who you can sell to and what you can sell? I don't think that's been appreciated by the market yet. Are you going to continue to invest in data centers at the same accelerated pace if you're going to be throttled by the government? And meanwhile, Chinese models such as Kimi, you know, K2, 2.7, GLM are rapidly catching up to the US. So here we see SpaceX.
Hey, Sean, what's going to stop people from just using a VPN and act like they are in the US?
Well, I mean, it's going to be worse than that, because remember, the Howard Lutnick told Dario Amodei, like they Anthropic hired like one of the most brilliant people in AI, Andrew Karpathy. Okay, I mean, like, next level thinker in this space, but he's not a US citizen, so he cannot use their models. And so they were like Amodei said to Lutnick, like, well, we just have to shut it down then, because unless we can identify who has a US passport and is in the US, well, we'll be offside. And Howard Lutnick apparently said, that's the point. So it's not just about a VPN. It's already hard enough to get an Anthropic account. Like, they don't take just an email. You also have to supply a phone number, and then they cross-reference that to an area code. Like, yeah, I mean, this is really something in my mind. And this is where the Chinese can literally start to catch up. And it was notable that Amazon apparently aggressively pushed the shutdown of the model to the State Department. Now, to me, that tells me that the Amazon researchers found that the Amazon cloud ecosystem was actually hackable by using this system. Amazon is a big investor in Anthropic, and they also rent an enormous amount of their compute power to Anthropic. Like, so they were willing to piss off a huge customer because if some hacker were to do an exploit and then take down AWS, that would be worse for them. And that's what's at stake here, right? Like, the banks are all trying to figure this out. The Treasury has been meeting with Anthropic to make sure that Swift and payment rails are okay. But it is a big deal. I get it. Here we see SpaceX.
Well, if you want to start just finishing up, if you want to come through our US platform where we have a Miami phone number and address and so forth, let me know.
Okay. And then you guys saw this last week, but my other readers have not seen this, and you can see all the shareholders and shareholders on the side, and board of director on the side, and even the investment bankers on the side, bowing down to King Elon in his corporate monarchy. Yeah, that's it for me.
Excellent. Okay, well, thanks for that. And I'm going to find out where Chris Curry's at. He's been not here for some weeks now. Paul, take it away. Take it away.
Yeah, hey guys. So I don't have much today. We're losing money every friggin' day in these markets, so we're finding it challenging, right? Lots of vol, lots of silliness going on, and of course we're long a lot of precious metals, and we're also long a lot of oil. So if one's going up, the other's going down, and vice versa. So it's a zero-sum game in commodity land. I will opine a little bit on the SpaceX. I would say this is the silliest thing I've ever seen in the markets. Are you guys aware that one of the clauses they threw in, the bankers threw in, if you wanted to sign up for this IPO, right, and you all had a chance because the Canadian banks were allocated a bunch of stock, but you had to agree that you would not and could not sell the stock for 3 months on an IPO, which I was with a bunch of brokers. They'd never seen that before. So everybody who bought the IPO price got issued the stock is in for the next 3 months. And so here's a prediction for you. August 11th, 100, well, whatever. How much did they allocate to the 20 billion, 30 billion to the retail public market? They're all going to hit the bid, every single one of them. So I don't know. I don't get it. If you look at the option market, it's very expensive to buy insurance. But if you just want to short the stock, it's the cheapest stock you can short anywhere. Just to give you an idea, right now they are charging us on Interactive Broker 0.43% to short the stock. 0.43. That's nothing gets cheaper than that in the money or the stock lending business. So that's very strange. Anyway, we're short the stock. We shorted at $200, and I just don't understand it. You talked about governance and all that, but Sean, and you're quite correct. I mean, governance is an issue. I think he's going to have to buy Tesla, right? It's not a question of if he's going to buy, he's going to have to buy it, because you can just imagine 3 months from now, everybody's saying, well, Elon, how much time are you spending at this company or that company? And that becomes the headline news. And it's just the valuation is just ridiculous. And the world bought into it. I think it's the biggest con of all time, right? To make a guy worth $600-700 million in a week, and give him all voting control, and his businesses don't really make money. Is a joke. Remember when we were studying finance, conglomerates traded at a discount to NAV. Like, where did those days go? And so I don't think it's going to work out very well for investors. I think it makes a far better short. And by the way, it costs nothing to short. So we're gonna do some, but of course you can't do much because what the heck do we know from sitting in Montreal? But if you're a value person, you can't even think about it because 100 times revenue in the history of mankind, who's ever made money investing at 100 times revenue, right? It's just the levels are too high. So what else did you catch last week? I mean, fascinating, right? Short report comes out on our biggest backer and probably one of the most impressive businessmen in Canada. Yet again, no support from anyone, right? One short report, 60 pages, of which 55 is complete garbage, and 5 is an interesting angle on their business. And Gildan stock goes down 25% in an hour. So just to give you an idea, a $10 billion company can lose $2.5 billion if anybody writes a little report and has a negative view. But not to be outdone, Mr. Shimani's cousin, who runs Group Dynamite, their stock was down 30. Okay, they announced their earnings. The stock opened in the morning up. A bunch of Bay Street research reports came out saying it was a beat across the board. And they started their conference call at 10:15, and take a look at the chart. The thing went into free fall and ended up being down 35% in a single day. Amazing fall. And so there's an example of no short report at all, but word getting out and a huge reaction on a company of the same size, $10 billion company. So maybe the short report's a big deal and kind of craziness, but then again, it can happen just on a conference call where management says something negative, guides down, and the reaction's impressive. So anyway, we took it as a gift. We're allowed to buy Gildan stock now, and we down 25% in an hour. We just said, oh, we'll buy some of that, and it's recovering nicely. So I don't know, what are we doing strategically? Take some money off the table and wait for these opportunities as they appear. And I think one thing's for sure, this market is going to give you opportunities. Every couple of weeks there'll be some new craziness that happens. And basically that's it for me. I mean, got nothing else to add. That's it for me.
Okay, thanks for that. Yeah, we own Gildan at very low, much lower prices. So I think it's time for us to average down as well. It's bounced off the bottom here.
Yeah, well, I think that might be a good idea.
And his brother-in-law's company got hit just because he's his brother-in-law?
No, this guy Andrew Lutfi is his name. He's actually, he's a cousin. So they share the same grandfather, right? So 2 billionaires come from the same grandfather. It's really quite something. But that Group Dynamite, have you seen this thing? It's truly amazing. It's gone from $1 billion to $10 billion.
What's the symbol?
GB. Hold on, let me pull it up here to make sure I got it right. GRGD. So Group GR and then GD for Group Dynamite.
Got it.
And
okay.
So this guy, Andrew Lutfi, by the way, owns 80% of the stock. So he's gone from being a wealthy guy to, probably worth $7 or $8 billion in a year. So they're opening these stores. It's focused on women's clothing, women's apparel. The younger group, sort of 12 to 20 categories, and his business is booming. His stores are full, and And
But the stock's getting killed now. I get out of the way of this one.
right.
Oh, it's
Down
had-
35% in an hour. I mean,
Yeah.
I've never seen something like that. I'm not even sure what he said, but somebody said something negative. So
Yeah,
For
May
what it's
May
worth, my,
1st. Yeah, May 1st in around May was time to get out of this one. It had two major sell signals and then it's had two more. Yeah.
yeah, it's not of the caliber of Gildan, you know.
No.
my heat map and trend meter had, big red on that on May 15th and May 20th. It was red top to bottom.
Yeah.
Shoot, I wish you had told us because that would have worked out nicely.
Well, we didn't have it on our list, so share your names and we'll do that. But yeah, this one there's still time to sell, put it that way.
So Kim Rivers, I've got to jump off. Kim Rivers is coming into our office in 5 minutes. So she's the head
Who's
of
that?
I
she's
gotta
the
run,
C-
guys. See ya.
Yeah, see ya, Sean.
She's
Who's
the
Kim
CEO.
Rivers?
She's the CEO of the second or first largest, most successful cannabis company in America, right? True Leaf.
Oh yeah.
And she was with Trump. She helped orchestrate all that descheduling for medical marijuana. And she just uplisted to the New York Stock Exchange last week, right? So went from the CSE in Canada to the New York Stock Exchange, which is a pretty big leap, right? For any company. So hopefully we'll learn something with what's going on in the cannabis space, which is all supposed to happen this summer. Not that you guys play a lot of cannabis, but I mean, it's interesting developments in the US.
Yeah, it's a 5 out of 5 on Dorsey Wright. Yeah, it's had a nice run already, topped out at 1850, and now it's on its way down. So, yeah, it's got a target of 2250. So, yeah, maybe time to buy some of this midway through this down. Probably settle down around $15 and then buy it there.
I mean, this company trades at five bid times EBITDA. It's got a good balance sheet, so it's not an expensive stock.
Well, yeah, take some good notes, and if they have any research, send it on to us.
I can do that. Yeah.
Okay. Okay, anybody have anything else before we say goodbye? Actually, Ken and Joe, stay on the line. I want to go through something with you guys.
Cheers, guys.
We've already lost Joe. Okay, see ya.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnichollasset.com to learn more.